With the banks in crisis, talks of a recession coming, the Fed have just raised interest rates yet again, now sitting over 5%. Now, as investors, it's pretty obvious that we want everything that we've invested in, whether that be stocks, bonds, crypto, gold, property, whatever. But unfortunately, as much as many people don't want to hear it, the interest rate set by the Federal Reserve does have a big impact on asset prices. So in this quick video, I'll just cover what's just happened, how this impacts the markets, and then what investors need to know. The Federal Reserve, aka the Fed, is the central bank of the United States, and it's responsible for setting monetary policy, which includes adjusting interest rates. Now, when the Fed raises interest rates, this essentially makes borrowing more expensive, and this is bad for companies as they borrow money for growth, and it's also bad for consumers as credit cards, loans, and mortgages become more expensive. So the bottom line is high interest rates are not good for growth. So the problem that the Fed has is that they're essentially always fighting two main battles. One is making sure that asset prices like stocks and bonds keep going up over time, and two is making sure inflation stays down. So it's important that stocks and bonds don't crash, as it's mostly made up of people's retirement money. So corrections are okay, bear markets are okay, but not big crashes. And then obviously with keeping inflation down, there's no point having money if it doesn't buy anything. So it's also very important. And so, interest rates need to come up to slow down the economy, but remember, this is not great for asset prices. In fact, let's just take a quick look at what rate hikes have done in the past. So, two very important charts to cover, and the first one is the relationship between the interest rates and a recession. So this is from the Fed's website, and this is the Fed's funds rate, the interest rate. Now, the one thing that really jumps out on this chart is what happened in the 1980s. As you see, Volcker ramped them up to almost 20%. So this was a crazy time for sure, but I think the more recent data is more useful, as in the year 2000 marks the shift into a digital economy. So this data is going to be more useful for us. So here's another big point, is that with the Fed's funds rate now just going over 5%, it's not been this high since the Great Financial Crisis. Obviously not good. But the correlation here that I'm trying to show is that when you raise up interest rates, it typically precedes going into a recession. And the recession are these gray bars here. So obviously jacking up to almost 20% led to a very severe recession. Jacking up interest rates not too long before recession. Same here, jacking up interest rates preceded recession, jacking up interest rates preceded recession. Same here. So the track record is a steep increase in interest rates slows down the economy, which is very likely to take us into recession. So the big question is, what happens to asset prices in a recession? Well, glad you asked. And this is the S&P 500. So same thing, but this one's going to show what happens to stocks in recessions. And again, the gray bars are the recessions, so nice and easy to spot them. And it doesn't look good. So let's just take a few, starting in the middle. A recession was very bad for the stock market. Here, a deep recession, very bad for the stock market. Here, very bad for the stock market. Here, bad for the stock market. Here, terrible for the stock market. Another drop in this tiny recession here. So for me, this data is very clear. If we go into a recession, higher risk assets like stocks are not going to do very well. They are probably going to come down. And when it comes to crypto, with only a real sort of 10-year history, there's not enough data. But if I had to guess, I'd say it's going to get bundled in with high-risk assets and likely going to fall. And it's the lower-risk assets, things like savings accounts and bonds, that are better investments in hard times. And then add to this mix the fact that the banking system is already struggling to keep up with these rapid rate increases. The regional banks are getting crushed in a sea of red, and the world's richest man also doesn't think this is just the smaller banks, saying this is a massive problem. Doesn't make sense to keep money in a less than 1% interest bank account instead of a 4.5 money market treasury bill account. As more people and companies realize this, bank depositor flight will accelerate to extreme levels, even for banks that are too big to fail. So, is now the time to sell up and run for the hills? Well, if you listen to the greatest investors of all time, they all say no one knows what's going to happen in real time. Now, there are plenty of people that will tell you what's just happened and that it was obvious, but it's doing it in real time that is difficult. I think just take a pinch of salt from anyone who just says everything's going to rally, as higher rates generally mean headwinds for higher risk assets. Now, does that mean that stocks and crypto cannot rally? No, it just means that there are headwinds. So, bottom line, higher rates are good for getting inflation down. They are good for things like savings accounts, but they're not so good for higher risk investments. So there you are, guys. Hope you enjoyed, and until next time, bye for now.